if let's say we have a weaker employment report, the Fed, it may force the Fed to rate cut earlier, all right? So this will be positive for the stock market. Hence, you can see that upon these few events, after the FOMC plus after the employment reports, you can see that market turned bullish. Good afternoon, everyone. It's end of the month again, and welcome to our monthly market updates for Busy People series, where we will keep you up to date with the global stock market while you are having your lunch. I'm Chye, a financial market analyst and coach at Beyond Insights, and this is your express session to get up to date with the stock market. So before we start, just an important note, whatever we share here today is based on the latest data and also facts. If there is further development, things may change. And we want to make sure that you know that we are not a licensed investment advisor and we do not manage customers' funds. We are an educational institution, so our purpose here is to educate people so that you can make your own decision and be your own investment manager. That way, you have a better control over your decisions and hence be able to get better results. If you are looking for stock tips, this is not the place for it. All information we share here are meant for educational purposes only and must not be taken as a recommendation to buy or sell. All right, so let me start the timer. All right, as usual, let's start with the market highlights. So how many of you have been active in the stock market over the past months? You may type in the chat. All right, so how was the market performing? So the market was bullish. It was volatile towards end of April, but the market turns after the following events. First of all, we have the FOMC, where the Fed mentioned about slowing down the pace of the balance sheet reduction starting from June. So this triggered some sentiment change throughout the market because the Fed going to reduce the tightening, slow down the tightening of the balance sheet. And also at the same time, the Fed chairman, Jerome Powell, also mentioned about he expect the inflation to come down eventually. And also he also mentioned about strong US economy. And also at the same time, what economy indicators we have that cause the market to continue its uptrend. So first of all, we have the inflation indicators that's showing that for the first time in 2024, it actually meet the expectation. And at the same time, we do see that the core inflation has been lowest since May 2021. So this is a positive news for the stock market. And also at the same time, we do see that employment report shifted, a weaker employment report shifted the overall sentiment. So how many of you here aware of the jobs data and what is the impact towards the jobs data? If let's say, for example, if let's say we have a weaker employment reports, what will likely happen for the Fed? Yeah, so if let's say we have a weaker employment report, the Fed, it may force the Fed to rate cut earlier, all right? So this will be positive for the stock market. Hence, you can see that upon these few events, after the FOMC plus after the employment reports, you can see that market turned bullish. So what investors and traders can do, so the risk asset has been rallied after the Fed press conference and also the employment reports. So investors can wait for the entry near strong support with good valuations. So you can see that investors usually don't simply enter just because of the market turn bullish. You need to do your own homework. Like I mentioned in the past market update, you need to do your own homework, do all the valuations, and only enter near the strong support level when you have a stock with good valuation. While traders may trade the trend of the market. So usually traders will follow the trend of the overall market. So if let's say market are trending up, then traders usually will go long to trade those stocks that are trending together with the markets with catalysts. Let's move on to the next one. So as an investor, usually we also check the stock market performance before we enter the market, and also we want to take a look on the big picture of the global stock market. What is the outlook of the overall stock market? And we want to choose the most consistent market. So from here, we can see that the Nasdaq 100, which represent the top 100 tech stocks in the US, are currently making new highs. They have been achieving a new all-time high after the sentiment change, after the FOMC and also after the Jerome Powell's press conference. Market reacted positively and it continued its uptrend after a volatile period during end of April, around here. During volatile period, during end of April due to some geopolitical uncertainties. But that time we do see some of the stocks are closing to a good valuation entry point. And if let's say you do your homework, you should be able to get in when you see the reversal sign in the stock chart itself. And other than the Nasdaq 100, let's take a look on the S&P 500. So the S&P 500 represent the overall top 500 stocks in the United States. And we can see that it also forming an all-time high after the Fed meetings and also the sentiment change after the Fed chairman's press conference. So we can see that S&P 500 also reacted positively. This shown that overall stock market in the US are recovering into an uptrend after a volatile period back in end of April. And at the same time, we can also compare other market as well. So we do see that China market recovered recently as well. So how many of you aware of the China news about some stimulus or something that caused the market to recover in China? Yes, there are a lot of fiscal policies, which is government policies and also monetary policies from the China Central Bank and also China's government. One of the key catalysts will be the PBOC actually announced to set up a nationwide program to buy back or to fund the loans to purchase all these unsold homes. So that PBOC, in fact, announced around 300 billion yuan, $41.5 billion in loans to fund the state purchases of unsold homes. So this is a move by the government actually to support the property market. And at the same time, due to the trade war, you can see that all these sanctions and so on, especially on the semiconductor sector, the China government actually set up a fund with $47.5 billion to boost the semiconductor sector. So they are funding their semiconductor sector as well. And this caused some bullish reaction to some of the Chinese stock as well. So we can see that the overall, based on the stock charts, the China market actually shown some recovery. However, in the long run, we do see that there are still a lot of fundamental problems that the government need to solve. For example, we still have a geopolitical tension ongoing, all the sanctions and tariff, and also at the same time, China having a high youth unemployment. This caused a lot of people, a lot of youngsters are jobless now. And at the same time, they also have this low inflation issue or deflation issue where people are unwilling to spend. And other than that, we still have the property crisis despite the government are creating funds to buy back all these unsold property. But in the long run, we do see still have some fundamental problems or macro problems in China. And also at the same time, with all these tariffs going on, we do see that the foreign funds may continue to flow out from China. For example, if let's say US implement more tariff towards the China company, all these China company may want to shift their supply chain or shift their factory out from China in order to escape the tariff and so on. So we do see that potentially they will cause another round of supply chain shift in China. So do monitor for longer term whether the recovery can be sustainable, because we do see that China still having some fundamental issues especially on their macroeconomy side. And next one, we do see that Hang Seng Index also recovered as well, if showing some trend recovery and hitting resistance near 20,000 level, around 20,000 level now having some resistance over there. And for Hong Kong, it is quite correlated with the China economy because they are closely linked with China, and at the same time they are open market to the world. All right, so Hong Kong also is one of the open market to the world and also tied with the US as well. So they has been caught in the US and China trade war crossfire all this while. So we do see that US-China trade war, and all this geopolitical tension, and Hong Kong has been stuck in between that, caught in the crossfire between these two nations, and they have been suffer some double whammy early on because they exposed to global market and also at the same time they are closely linked with China market. So we can see that early on when US raised rate, Hong Kong market also suffered, and now when we have a closer to election and US election and we have some tariff ongoing, Hong Kong market also affected as well, and even the property crisis or economy slowdown in China also affected the Hong Kong market. So macro view wise, if let's say we take a look on the overall macro view on Hong Kong market or the Hang Seng Index, is prone to tech war, is prone to all this geopolitical tension, and also at the same time is closely linked with China market. Hence, you can see that over the past few years, the Hang Seng Index has been quite bearish and going sideways or downtrend, and recently showing some recovery sign. But similar as what we have in the China market, we may need to monitor whether the recovery is sustainable, because as long as, if let's say China economy still slows, then it may affect the Hang Seng Index as well. And lastly, we have the Bursa market, Malaysian KLCI market. So currently, what trend is our FPM KLCI in Malaysia? Anyone that active in the local stock market? Yeah, it's in an uptrend, and we can see that the foreign funds has been coming back to Malaysia. We can see that recently a lot of data center announced their investment in Malaysia market, and we also see that the government has been gaining traction in terms of political stability. So recently we do come across the news, politics news, as well as all these investment news. So political wise, the new government or the government has been gaining traction in terms of stability, and at the same time we do see that foreign companies are coming in. For example, yes, Google are coming in, Microsoft also coming in, and also we can see that Nvidia also setting up their data center or work with YTL Power to setting up their data center in Malaysia as well. So we can see that Malaysia market has been recovering, foreign funds has been coming in, and one of the key factors or one of the key things Malaysians favorable to the Malaysian market will be the Singapore's national AI strategy, where they want to become global leader in the development of AI, and this actually benefited Malaysia. This is because Malaysia, we have better resources in terms of power and also land. So if let's say Singapore aiming to become a global leader in AI, they usually need more data center. And we are and for Johor, they are in border of in near to the border between Malaysia and Singapore, and they are benefited from this Singapore's national plan because of in Malaysia we do have plenty of power utilities, especially power and also water, and also at the same time we have plenty of land to set up all these data center. Hence, it will be we also benefited from all these Singapore's national AI strategy, and also at the same time all these multinational company like Google, Microsoft are looking for places to set up new data center in the Southeast Asia region as well, and Malaysia also benefited from it as well. So for those of you that are investing in Malaysian stock market, you may watch out for certain industry, for example, the utilities companies and also some of the construction company. All right. So I'm not giving any tips for here. So you may continue to do your own due diligence, go through the companies in Malaysia, whether they are fundamentally strong, whether their technical charts are showing you a sign of potential setup and so on. But overall, I would say construction sector and utility sector are something we worth to monitor for Malaysian market. And so from the overall comparison, which market do provide the most consistent return among over the 10 years period? Which market actually providing the most consistent return? You may answer me in the chat. Yes, the US market, in fact, are the one that providing the most consistent return. You can see that overall, they are averaging around 42.76% gain per year. If let's say you take the 10-year average gain, and for S&P 500 is around 18%, around 18% to 19% return potentially. And for traders and investors who are looking for high growth or looking for high growth companies, the US market will still have the most high growth companies and also the most global brands throughout the world. All right, so they are the global market for United States. So why I said so? So how many of you heard about some global brands that are coming from US before? You may type in the chat. What are the global brands you heard or you heard before that are coming from the US market? What are the global brands that are coming that are from US market? Listed in global in US market. Yeah, we have all these Apple, Microsoft, and so on, Microsoft, Google, and so on. And what are the recent stock market drivers or industry trends in the stock market? For example, what are the recent global trends or industry trend? Yes, you can see about AI, data center. So how many companies you come across all these? How many AI companies you come across are coming from US? They are high growth recently. There has been keep on growing their revenue, growing their net profit, and so on. Yes, we have Nvidia, we have Microsoft, Google, and Amazon. All these are AI related, data center related company, and we can from here also we can see that the US companies are in terms are having higher growth compared to the rest of the regions, and also they are providing more predictable returns. For example, if let's say you choose those strong fundamental stocks in US, or just based on the index itself, also we can see that they are providing a more predictable returns compared to other regions. All right, so from here we can conclude that US stock market still having the most global brands company available, and also at the same time they are one of the leaders in AI, and also with recent catalysts, we can see that US AI related stocks also been rallying, and also at the same time based on the 10 years average, we can see that they has been providing the most consistent return compared to other countries. And on top of that, we also have money on the sidelines. So we can see that there are a record of 6.3 trillion in cash still on the sidelines. So partly for this money market, so on the sidelines, so they have been parking in the money market funds. So what are the money market funds? Money market funds works like our FD. So usually all these funds, when they are in cash position, they will park their money in all those money market funds to earn the interest rate, risk-free interest rate. So and part of the reason why investors are stocking up all this cash is to take advantage of the current high risk-free rate due to high interest rate. So how many of you or any one of you here know what is the current US interest rate? All right, so current US interest rate around 5.5%, around that region, around 5.5%. And you can see that why those funds are parking in cash position, because they can earn 5.5% of risk-free rate. However, things may change when the Fed start to reduce their interest rate. So we may see that when the rate hike cycle is ending, so we are currently nearing the end, or I would say it's already the end, just that we may need to monitor few more parameters, for example, like the inflation, in order to confirm the rate hike cycle is ending. And when the rate hike cycle is ending, or when the Fed start to cut interest rate, we do see that this massive 6.3 billion pound of cash may move from cash position to either the bond market or the stock market itself. So this is the transition point where the funds or investors are looking for. Once the Fed pause the interest rate, or once the Fed start to cut the interest rate, they may move some of their cash position to stock market or bond market, and they may want to lock down some of the bond market as well. And yes, I see some question in the chat into crypto as well. Yes, crypto also potentially one of the target they may moving, especially we do see that risk asset has been rally these few weeks. For example, stock market has been on a new high, and also at the same time we do see some recovery in crypto as well, especially Bitcoin and all other bigger coins as well, other more popular coins as well. However, crypto itself is a more risky asset, and the funds may move in only if, let's say, you see more and more ETF got approved in the crypto market. So we do see that currently we have how many approved ETF for crypto in the market? Any one of you following all these crypto news? How many approved ETF we have now in the US stock market? So we have Bitcoin ETF, then Ethereum ETFs recently have been approved as well. So all this may cause some funds to actually diversify some of their funds into crypto asset as well. And we may continue to monitor this trend as well in the crypto market. But I would say this $6.3 trillion of cash is a huge amount. So if let's say it follow to the stock market, it may cause some bullish sentiment as well, or sentiment change as well to bullish, strong bullishness sentiment. And also at the same time, if let's say it flow to crypto market, it may boost up the crypto pricing as well. So I would say the transition point will be very important. For example, let's say when the Fed start to cut the interest rate, or when we have clearer picture on when Fed going to start to reduce the interest rate, this may cause a asset rotation to all these high risk asset or risk asset as well. All right, so we may continue to monitor this, and a few indicators are quite important to monitor will be all these inflation indicators and the upcoming FOMC as well. This will give us the clue that when the Fed expecting to start to reduce the interest rate, and when that happens, potentially that may have some asset rotation into risk asset. So we may wait for all these potential sign, and based on the stock charts to time our entry to the right asset and also right stock tickers. So this is the best time for you actually to do your homework, go through the stock list that are giving good valuation, high potential growth. Also at the same time, start to look for other risk asset as well. So once the transition point happen, overall macro views changes, then the funds may start to have all these asset rotation ongoing. So as an investor, usually we evaluate the risk or check the potential risk first before we evaluate the potential opportunities. So we want to play the defense first before we go on offensive. So this is to protect our capital. Protect our capital first, only we talk about offense. So let's take a look on the potential risks that we have in the recent market. So first of all is the potential delay or lesser rate cut. So based on the recent inflation data, despite the inflation figures actually meet the expectation or meet the forecast, and we do see that the core inflation are the lowest since May 2021. However, we do see that the overall trend for the inflation are still going sideways, And if let's say the inflation for the coming months are still on the high side or going sideways, going nowhere, not trending down, then this may delay the rate cut to November for the first rate cut. And that there might be lesser cut for the year as well if let's say inflation remains sticky. So this is a potential risk because some of the Fed members actually having some divergence in terms of their opinion. For example, their chairman, Jerome Powell, actually mentioned about he expects the inflation eventually coming down, and he also during some of his press conference, he also mentioned about they are not going to increase interest rate. However, some of the members actually having some divergence in terms of opinion. They mentioned about potential, they want to vote for rate hike if let's say inflation remains sticky, or they are going against rate cut if let's say inflation remains sticky. So the coming inflation figures will be crucial for the stock market and also other risk assets because these are the most watched indicators now, the inflation indicators. And also at the same time, all these FOMC, all the Fed meeting, all the US central bank meeting coming months will be important. So the next one will be inflation reduction sustainability. So like I mentioned earlier, the interest rate has been on a high level since for a while. Since back in 2021, they has been increasing the interest rate, and they start to pause the interest rate back in 2023, around late 2023. And now we are in mid of 2024. However, the inflation still remain around 3% since January 2024. Despite 2023, it has been trending down after the rate increase, but from January until now, the inflation are still around 3% region, going sideways. So some of the Fed members or some of the analysts do view that whether the inflation reduction effort in the past can be sustained or not, because we still have a strong demand in terms of US housing. Let's say we break down all these inflation figures, we still have having some high figures in terms of housing price in US still stubborn, still on the high side, demand still high, especially for the housing side in the US. And also at the same time, we do see that increase in all these transportation costs or logistic costs. So this cost, the goods in the US are still on the high side, and also at the same time, all these services, despite we see some reduction in the past, services still are at a higher price. And we do see that this trend may continue if let's say we still have stronger jobs data or strong employment data. People with their wages or people with high salary may still continue to spend for housing, still may spend for all these All these are other items that involve that can boost up the transportation costs and also logistic costs. So a lot of Fed members also do see that if let's say inflation reduction effort cannot be sustained, they may consider to increase interest rate, and this may affect the market negatively if let's say the Fed surprise everyone and continue to increase the interest rate. However, based on the current information or based on the analysis like from their Fed chair and so on, for now I would say there is no plan for rate hike yet, but anything can happen. We may need to continue to monitor their meeting outcome as well. And next one is the geopolitical tension. So how many wars we have in the world currently? Yeah, currently we have war in the Europe region between Russia and Ukraine, and same time Middle East we have war between the Israel and Hamas, and recently we do see Iran coming into the picture towards the end of April, but that has been settled down, luckily has been settled down. But like some of you mentioned in the chat, the war in the Middle East, geopolitical uncertainty may cause the oil price to go up and may cause inflation to remain sticky. And at the same time, we have this China and US tech war, China and US tech war. So how many of you recently come across some news about the tariff? You may type in the chat, US announced new tariff onto China goods. Yes, so EV car tariff, all these glove tariff, plus all these solar panel tariff. So usually when we have sanctions or tariff, usually the first victim will be consumer end. So we do foresee that with all these tariff, in the end, the cost will pass to consumer. And if let's say all these tariff costs pass to consumer, what will happen to the inflation? It may affect the inflation to increase as well. So with all this geopolitical tension around, we do see that potentially this may cause the inflation to remain sticky. This is because firstly is the oil because of war, and secondly will be all these tariff. Tariff usually the cost will pass to consumer, and if let's say pass to consumer, then it will cause inflation to continue to go up. And at the same time, we also do see that due to all this geopolitical tension and also at the same time, we do see that some supply chain shift in terms of semiconductors. So how many of you heard about this company before, TSMC? Yes, so due to the tech war, some geopolitical tension between China and US, they are actually shifting their supply chain. So they are opening up plant in US, opening plant in Europe, opening their new plant in Japan. And all these new branches or new factories involve operating costs, and they do come out, some of the they do announce during one of their earnings announcement for TSMC, they do announce that potentially they want to increase their price for those chips that produce in all these foreign plant. So we can see that if let's say all these chips that are produced in foreign plant get a price increase, this may also pass to consumer in the end, and this may cause inflation in electronics related items. For example, all these consumer electronics items or all these laptops or CPU or even like laptops and smartphone may have a price increase as well. So all this geopolitical tension actually contributed to the inflation, and it may cause inflation to be higher. And inflation goes higher, then the Fed may either remain the rate at this rate, just pause the rate and wouldn't go for a rate cut first, or reduce the number of rate cut they have. And also at the same time, with all these high inflation, high interest rate, so this caused a slower consumer spending recovery as well. So first of all, as we know, China is one of the, I think it's number 2 or number 3 in terms of nation for consumer spending. So if let's say in China we still have this economic crisis, property price still weak, people still not willing to spend, or still a weaker retail in China, then this may cause a slow recovery for all these retail related company or retail sectors. For example, like Nike, Starbucks, and so on, that having a higher exposure to China or rely more income from China all these companies may have a slower recovery. And also at the same time, high inflation may slow down the consumer spending recovery. This is because usually when we are having high inflation, people tend to spend less on discretionary items, spend less on those not unnecessary stuff. They only spend on essentials. And usually all these consumer discretionary item, people may cut their budget for all these consumer discretionary item. And lastly will be PC demand recovery. So as in the past market update, we do mention about laptop market recovery, smartphone recovery due to the upgrade cycle. For example, back in 2020, a lot of people actually upgrade their phones, upgrade their laptops during pandemic. And now we are 4 years cycle due, and usually 4 to 5 years will be the upgrade cycle for all these laptop and also smartphone. However, due to the higher inflation, people may cut their budget. People may cut their upgrade cycle, may delay or prolong their upgrade cycle. So we do see that all this PC demand or smartphone demand recovery may be delayed. However, we do see that there is some ongoing trend in the consumer electronics market as well. Especially nowadays, we see all these AI phones, AI laptops, and so on. So this may boost the demand. This may boost the demand, or this may trigger the interest for people to upgrade their laptop and also smartphone as well, because they have this new AI function or AI chip in their laptop or smartphone. So we may continue to monitor whether second half of this year or first half of next year, whether any recovery on this PC sector or smartphone sector. And next one, let's take a look on the opportunities. What opportunity we have in the current market? So first of all, we'll be focused on all these industries that are in line with key themes. So for example, mega trends like AI, cloud computing. These are the trends that we are seeing in the stock market that are able to sustain, I think, coming years. For example, not only in the US. So let's say in US, you do see that NVIDIA, Microsoft, all these companies are doing well. However, for AI, it's not only involved on all these chips company or all these cloud computing companies. At the same time, we do see that utilities company, that those providing power to the data center are also benefiting. For example, like in Malaysia, we do see that utilities companies are benefited from all this Singapore plan. And also in the US, if let's say you are monitoring different sector, for example, the utility sector, you can see that some of these power companies that are providing power to all these data center, or those power companies that are providing power solutions to all these data center are actually quite bullish as well. So we can continue to monitor all these mega trends related to AI, related to cloud computing, and the supply chain or the chains that are involving all this AI and also cloud computing. For example, cloud computing need data center need power, data center need construction and cooling system and so on. So all these industry likely will be benefited as well. And the second one will be industry recovery. So for example, the server market has been slow in the past few years, I would say, before the AI boom. So we can see that server demand increased during this period, during the AI infrastructure and expansion cycle. We can see that server demand also recovered strongly. For example, some of the computer assembly company, or especially those focused on data center computer like server company, selling those companies that are selling server solutions to all these data center, has been doing quite well recently as well. And next one will be companies with low debt, low exposure to bonds, and also strong cash flow. So basically, this refers to company with strong fundamentals. And how many of you or anyone know why you want to choose a company with strong cash flow under high interest rate environment? Why you want to choose a company with strong cash flow under high interest rate environment? Yeah, because if let's say those company with strong cash flow, they will able to no need to commit debt, and also if let's say they are having a lower debt, then they no need to pay high interest. All right, so during this period, those high debt company will need to pay a lot of loan interest compared to those with low debt and also strong cash flow position, because those with strong cash flow, they can still expand their business despite we are having a higher interest rate, and they are more resilient during economy slowdown as well. And the third opportunities will be consumer discretionary recovery. This one, I would say, watch out for the rate reduction picture direction. So when we have clearer picture on rate reduction, this sector is the sector that worth to watch out, because they has been over penalized over the past year. All right, if let's say you check on all these retail stocks, consumer discretionary related stocks, they has been on a downtrend, and even the stock market now is all-time high. They are still on the low and forming the bottom. So when we have more clearer picture on all this rate reduction, this consumer discretionary sector will be a sector that worth to watch out for, especially those credits related, consumer credits related, for example, or travel related, or even retail related. So all these are potential opportunities if let's say we have a clearer picture on rate reduction. However, we do see some recovery in the travel sector and also credit sector early on, but now they have been weakened recently as well. So we may continue to monitor these few sectors or industry. And lastly, the second last one will be companies with lesser revenue dependency on foreign markets. So why we say so? Because we do see that geopolitical tension, especially between US and China, may still remains. So when you are selecting companies in this current stock market, you may choose those with a better balance in terms of revenue exposure. For example, Microsoft having a 50-50 revenue exposure and having a lesser exposure in China. For example, Google having lesser exposure in China. So you can choose those companies with a more balanced revenue distribution or dependency, so you can still profit from the company still can make money from other region other than China, because we do see that more and more tariff will be introduced, and also more and more sanction or bans might be introduced, especially when we are closer to the election. Both party, for example, Republican or even Democrat, in order to secure the votes or secure the support, they may announce or they may propose a lot of new policies to go against China due to the tension between US and China, and also how they want to secure the votes in terms of political campaign. So we may need to watch out our exposure, especially those exposed to China one. We may need to reduce the holdings or stay away from all these companies that are heavily reliant on foreign revenue, especially from the China market. And lastly will be the money on the sideline. So like I mentioned earlier, 6.3 trillion in cash on the sideline and potentially come into the stock market or bond market when the rate high cycle is over. And even crypto market, they may go into the crypto market through the ETF that are approved by the SC. So these are something worth to monitor, especially now we are at almost close to the end of a rate high cycle or almost close to a first rate cut cycle. So you may need to monitor this one for the asset rotation movement, like I mentioned earlier. And since this is just a 30-minute market update, so we would like to invite you to a free 3-hour webinar that covers a framework on how to approach the stock market in a systematic, versatile, and also safe way. We have the most systematic course in the market. We have a process map for every trading style or process step for every trading style. And we have a versatile strategies to handle all market conditions. And we have a safe approach to to have a proper risk management as well. And you need to plan in some time to practice and pick up a skill set while waiting for the opportunities. Even the market now are at all-time high, there are still plenty of opportunities. And if let's say there are some pullback happens, like the past few months, a volatile period, you know which stock are worth to go in during that opportunity or during that pullback or during that volatile period. And also we have a hybrid class for coming intake, so do join the 3-hour webinar to find out more. And the next available webinar will be 30th May, which is today, 7:30 p.m. tonight. So if let's say you're interested to join this webinar, you can scan the QR code for registration. And if you find this market update is beneficial to you, do recommend it to your friends as well. You can join us every end of month. Usually we will set up a session for all this express market update. And with that, that's coming towards the end of my session, and I will open the floor for Q&A. So you may type your questions in the chat and I will answer some of your questions. I will pick 1 or 2 or maybe even 3 to answer some of your questions. So you may take this opportunity to type your question in the chat. All right, so let's take a look on just now I see some of the earlier questions, for example, how US presidency election affecting the scenario. All right, so as we know, towards year end, November, will be likely we will have a US election. And usually during election period, things may get volatile because depends on which party going to win. They may have a different kind of fiscal policy, and this may affect certain industry or certain sector. However, now we are still at an early stage. But one of the common thing we do potentially see will be during the campaign, both party like either from Biden or Trump, they may announce or they may announce more harsh, or I would say they may announce policy, especially on the China side, especially like for example more tariff, more sanction or ban towards China, or more strict tariff or more strict sanction to China, especially all these tech-related industry or those industry they are competing in. So we do foresee that more and more news about all these sanction or ban or during the debate or during the campaign, they may give statement that are more harsh to China or more critical to China. So this you may need to watch out for those companies that are highly exposed to China. You may need to reduce or stay away, especially during the campaign period. All right, so for now it's still early. We cannot know the future, but I would say China is one of the target of the targeted topic for all these campaign, especially between Biden and also Trump. So if let's say you are investing in the stock market, do stay away or reduce your position, especially involving those companies that are very sensitive to China. Okay, so another question will be what are the strong data they are looking now in order to cut rates? All right, for this one is the inflation. The Fed actually want to see the inflation continue to trend down. So if let's say we do see the next coming data point for inflation, if let's say going closer towards the 2%, for example, now we are still sideways at 3%, around 3+%. If let's say you start to see data points coming towards below 3, that will be a positive sign for the market. So the coming months, all this inflation announcement will be very important because if let's say inflation start to trend down, no longer going sideways, start to trend down, especially when trending down below the 3% line, let's say 2 point something percent, then you may see that the market may react more positively. And the Fed during the FOMC, if let's say they see enough data point about lower inflation or inflation start to trending down, they may start to announce some rate cuts or even some timing of the rate cuts going forward. So the inflation data itself will be the very important indicator to watch out for, especially the coming months. And also, lastly, yeah, I think that's all for the Q&A. And the oil price itself, I think oil price may settle down if let's say based on some question in the past also, war in the Middle East can boost up oil price leading to sticky inflation. Like I answered earlier on, inflation, energy side is more towards the geopolitical tension. So if let's say things are settled down, you may monitor the oil price chart. If let's say the price start to trending down in the oil price, then it could be helpful to the inflation as well. All right, with that, that's coming towards the end for the market updates. Hope you all find it beneficial. And if let's say you find it beneficial, do introduce this to your friend as well. And with that, I'll end this market update. So hope most of you have a good session today, and see you all again next month. All right, see you all. Bye bye.